A car payment feels completely normal right now. Most people around you have one, your coworkers have one, your neighbors have one, but there's a version of a car payment where you're just covering transportation and a version where you're quietly losing thousands of dollars you don't even realize you're spending. The difference between those two isn't just the interest rate or the price of the car, it's a whole stack of decisions that compound on top of each other in ways most buyers never see coming. Hey, what's up? I'm glad you're here. This video is about every major car payment trap that exists right now in 2026. And I want to walk you through all of them because understanding just one or two isn't enough. The average new car payment is $770 a month right now. The average loan is nearly $44,000. And the average loan term is almost 70 months. Almost 6 years of payments on something that starts losing value the second you drive it off the lot. Let's get into it. The first trap, and one of the most powerful ones, is the monthly payment trick. When you walk into a dealership, the salesperson is almost never going to ask what price you're looking to spend. They're going to ask what monthly payment you're comfortable with. That shift in framing is not an accident. Once you're thinking in monthly payments, they can stretch the loan term and make almost any price feel affordable. Here's a real example. Take a $43,925 loan at 7.52% interest, close to the current average rate for new car buyers. At 60 months, your payment is around $881 and you pay about $8,900 in interest. At 84 months, the payment drops to $674, which sounds much better, but you pay about $12,700 in interest, roughly $3,800 more, and you're in debt for 2 extra years. The payment went down, the cost went up. The dealer doesn't need to raise the price if they can just stretch the timeline. That longer loan creates a second problem that's even more dangerous, and this one catches people completely off guard. It's called negative equity. And right now, almost 31% of people trading in a vehicle toward a new purchase are underwater on their current loan. Their car is worth less than what they still owe. The average gap is over $7,000. So what happens to that $7,000? It doesn't disappear. The dealer rolls it into the new loan. You're now financing a car you don't own anymore, inside a loan for a car you just bought. That old debt alone adds about $124 a month to your new payment and roughly $1,764 in extra interest over the life of the loan. People call it the ghost car. You're paying for something that's already gone, and the reason negative equity snowballs connects directly to those long loan terms. A car depreciates fast in the first couple years, but a 72 or 84-month loan pays down slowly. For a long stretch of that loan, you owe more than the car is worth. If you try to trade it in early, you're not escaping a bad deal. You're making the next one worse. Even before you get to the trade-in, there's a trap happening right there in the finance office that most people walk right past. Is the dealer financing markup? When a dealer arranges your loan through a lender, they can mark up the interest rate above what the lender actually offered. Research has shown that these markups can add more than 2 percentage points to your APR, and most buyers have no idea it's happening because the dealer doesn't have to tell you. On a $43,925 loan over 72 months, moving from 7.52% to around 10% adds about $54 a month and close to $3,900 over the life of the loan. The fix is simple, but most people skip it. Get a loan offer from your bank or credit union before you go to the dealership. Then you have a number to compare against. The dealer can still win your business, but they have to actually compete for it. So now you've got a long loan, possibly some rolled in negative equity, and a marked up interest rate. Then you get to the finance and insurance office, and they start presenting add-ons. Extended warranties, gap coverage, paint protection, tire and wheel plans, prepaid maintenance. Each one gets presented as a small monthly addition. Here's what's actually happening. Those products get rolled into the loan, which means you're financing them and paying interest on them for years. A $3,000 add-on package financed over 72 months at 7.52% ends up costing you closer to $3,700 once you include the interest. The finance office is where a $3,000 decision turns into a 6-year payment. Some of those products have real value, gap insurance especially if you're underwater, but you should know the full cost before you say yes. There's a new wrinkle in 2026 worth talking about because a lot of people are misreading it. Starting in 2025, some buyers can deduct interest on a new car loan from their federal taxes. Sounds like a big deal. But a deduction is not a rebate. If you pay $3,000 in interest and you're in the 22% tax bracket, your actual tax savings is around $660. It helps. It doesn't fix a bad APR or an overpriced vehicle. Don't let that deduction be the reason you stretch into a car you can't really afford. And speaking of things that don't fix a bad loan, refinancing. It can go either way. Experian found that in early 2026, refinancing dropped borrowers' rates by an average of 2.2 percentage points and saved about $81 a month. Sounds great. The trap is refinancing to lower your payment by extending the loan. If your payment drops by $80, but your loan gets stretched another 2 years, you bought short-term relief with long-term interest. The good version of refinancing keeps the same payoff timeline or shorter, just at a lower rate. The bad version just restarts the clock. If you're finding this useful, drop a comment below and let me know which of these traps surprised you most. And if you haven't subscribed yet, this is the kind of content I put out regularly, so it's worth sticking around. Now here's the part that ties everything together. All of those traps are just the loan. The actual cost of owning a car is bigger than any of that. AAA estimated that the average cost to own and operate a new car in 2025 was about $965 a month when you include depreciation, insurance, fuel, maintenance, registration, and financing. The average full coverage insurance premium right now is around $208 a month. That $770 average new car payment becomes close to $1,000 a month before you've put gas in it or changed the oil. The payment tells you what leaves your bank account. Depreciation tells you what disappears silently. And right now, the average new car transaction price is sitting above $49,000, partly because buyers keep moving toward full-size SUVs and trucks. A lot of people compare monthly payments across vehicles without realizing they're comparing completely different financial outcomes over 5 or 6 years. Used cars aren't automatically the safe choice either. The average used car is listed around $26,000 right now, up 3% from last year. A used car with a high interest rate, no warranty, and a long loan term can get expensive fast, especially when repairs start showing up while you're still carrying a big balance. So here's where we started. A $770 monthly payment that feels normal because everyone around you has one. By the time you layer in a stretched loan term, rolled in negative equity, a marked up APR, finance add-ons, insurance, and depreciation, that normal payment can easily cost you $1,000 a month or more and leave you owing more than the car is worth for most of the time you own it. The good news, every single one of these traps has a counter move. Know your out-the-door price before you talk payments. Get pre-approved before you walk in. Keep your loan term as short as you can genuinely afford. And think about total ownership costs, not just the monthly number on the contract. If you want to go deeper on any of this, I've got videos on how to negotiate a car deal, whether leasing actually makes sense, and how to get out of negative equity. Those are linked right here and they're worth watching before your next purchase. Thanks for watching, and I'll see you in the next one.